fall. Arnab Das, MD, Market Research and Strategy at Roubini Global Economics now joins in. Arnab, hi. Morning to you.
Morning.
You know, before we talk about the European markets and the way the US market reacted yesterday, I'm sure you would have looked at the way Indian market has reacted today. Are you surprised by this fall, considering that India was already a big underperformer, and today we've seen a 500-point fall on the Sensex?
Well, I mean, I think the issue for the particular case of India is that the signals from the U.S. recovery and the Western recovery generally point to tightening in combination with a still large current account deficit and still unresolved issues, no matter what attempts are being made to address those issues, and changes of personnel for very good people. Despite all the very positive signals the Indian government is trying to send, those signals, those decisions are not going to have a short-term effect on the size of the current account deficit or on the trajectory of growth like I say, in the short term, right? So India is going to face the onslaught of tapering, and eventually, if the recovery continues in the United States and other countries, the onslaught of tightening before those measures, if they're implemented after the election, bear fruit, right? If reforms and other kinds of improvements take place, other than the short-term macroeconomic stabilization policies the government is engaged in. And indeed, those stabilization policies reveal that India is in a bit of a trap, right? It needs to keep liquidity tight. It has joined the slew of countries in emerging markets that are tightening monetary policy in order to defend their currencies and prevent importing inflation, even as credit growth and economic growth more generally are slowing quite sharply. So, although things had improved quite a bit in India and other emerging market countries in the 2000s, and things really seemed to take off after the global financial crisis, the reality on the ground is not as good as people had been led to believe.
Arnab, but if actually tapering does take place, as has been spoken about in September, is it priced in? Because we've seen the Indian markets underperform, as Anuj has pointed out, and even today it's fallen close to about 500 points. So the question is it priced in already, or is there more weakness in store?
Well, I think that's the many trillion-dollar question for India and many other countries, and indeed for various asset classes. I mean, I think if you kind of step back from the particularities of the scale of the recent moves and the current move in the Indian market, and just think about what QE accomplished, right? QE drove up bonds and equities in the United States and elsewhere in the world, right? So risky assets and risk-free assets, high-yielding assets, low-yielding assets, everything went up because the Fed created a lot of money. And the logic of so doing was to reflate assets, precisely what we're talking about, making asset prices go up, reflate assets to make the liability overhang problem easier to deal with until such time as the economy could sustain that liability overhang. If we're reaching that point and the money creation is going to slow down, that implies that asset classes across the board are going to go down. Right? Now, of course, part of the Fed's strategy in this asset reflation was to get everybody to buy everything, mainly in the domestic market, but of course there were spillovers into the rest of the world. So now, if everybody realizes this in their guts, if not in their minds, they're going to pull back to some degree, if not quite a lot, to see where the dust settles. So to me, it feels like the Fed's strategy was indeed to create a kind of quote-unquote technical condition in the market where the market was overbought. And now the market's going to have to go through some considerable adjustment and digestion and gyration in order to sort of accept the fact that it's all going to be about fundamentals now rather than about money. So I think the countries and the asset classes that are relatively weak, where they're relatively large exposures that were built up, whether by domestic investors or foreign investors, or in most cases maybe both, those countries are going to be, and continue to be for a while, in the maw of the problem, particularly if the things that they can do to respond to this issue can't bear fruit in the short term, right? So if the things that India and Indonesia and Turkey and Brazil, South Africa, various other countries have to do to stabilize their currencies and prevent a big inflation problem, is to slow down their economy, that's going to hit their equity markets. And indeed, part of the correction is going to be weaker equity prices and weaker currencies. So to me, it doesn't feel as if this is completed yet. The reprieve will come if there's a signal that the tapering will slow down, and then after we know about the scale and the pace of tapering. A temporary reprieve, because there'll be rounds of tapering, and then eventually there'll be a stop in the increase of money, and then there'll be a tightening in money if all goes well.
One more question. Just some time back you said that India needs to keep the liquidity tight to defend the currency. Many measures have been undertaken by the RBI as well as the government, but that has not yielded any results. And the rupee in fact opened at a record low versus the dollar. So do you see the possibility of more RBI, more measures to defend the currency, to tighten the liquidity, which again is going to, result in exacerbate the problem on the Indian equity market?
I think that could well happen. I think the way to think about this is that if the RBI had not intervened defensively to support the currency, what would have happened? It would probably have been even weaker. The inflation problem imported through the weaker exchange rate might then have been worse. And indeed, if the RBI is moving from the current framework under Subbarao towards Rajan's tenure in his coming tenure, towards something that is closer to let's say a single mandate or closer to inflation targeting, that only suggests that the direction of travel is towards more measures to deal with the potential inflation problem, regardless of their effect on growth or on equity markets, at least in the first round. Right? The second round effect, the knock-on effect of a weaker equity market, of a tighter credit condition on growth, would imply lower inflation in the future. But of course, the central bank has to act to prevent inflation expectations from getting out of control. So I think what we're looking at is many emerging market countries, and it has to be emphasized, this is not just India, many emerging market countries have been wrong-footed by the evolution of the crisis itself and the policy response to the crisis. I think what we're witnessing here is the comeuppance of too much hubris in the immediate aftermath of the crisis, that kind of aha moment where everybody thought the U.S. model was broken and the U.S. economy was broken and wouldn't really be fixed, and here was a chance to grow really fast and catch up really quickly. Shortcuts, usually don't work or create other problems of their own, and I think that's what we're witnessing. So policy was too loose in many emerging market countries immediately after the crisis and since the crisis, and that's led to a problem of imbalances that are excessive, and now we're going to have a problem of policies that need to be too tight in order to address those imbalances.
All right, Arnab, thanks so much for taking the time out and joining us on the show today. So that's Arnab Das of Roubini.